Good weekend, all. Ira Epstein with your Spider ETF stock market wrap-up, and this is your weekend edition for President's Day weekend, and this is the 17th of February, 2023. Well, the battle continues on between the naysayers that go, I don't care how strong the economy is, the Fed's going to back off, they can put rates up 1, 2, 3, they'll go down like that. I was reading reports like that today. That's the naysayers report. Others are scratching their head. And every Fed member is saying, this labor market is out of balance. That's the word they use over and over. It is just so strong. And if that strength stays in, a couple of things. Number one, never seen a deep recession where everybody's employed. Have you? It doesn't exist on data records, I can tell you that. But I've also not seen the market beat the Fed. And the Fed's job here is to get inflation back to 2%, they say. I have gone on record and I'm saying, no, I don't think that's the case. I think 2% is a fictitious number. It's sort of like when we had washing machines that you cranked by hand, if you can remember those things. They're always in the old movies, right? In Westerns. What's wrong with 3% is the new norm? You make money, dollars, not a dollar anymore. You know, a nickel doesn't buy you what a quarter did, just 2 years ago. Just think about it. How much does gum cost? Okay, I realize I'm older, but not that old, all right? Everything costs more money. Go to the grocery store. You think it's cheaper now than it was a year ago? I don't think so. So why is 2% inflation going to work for things way back when? When are you going to get eggs for $1 a dozen again? These are the points that I'm making. You got to adjust with what it is. More money, more in circulation, creates inflation. They're not taking that all out of circulation without breaking the economy, and that's not their job. Not the Feds. They're to keep a stable economy, control inflation, full employment. They have two mandates. Presidents say it's going to end this Monday. So you have the weekend to take advantage. Now, what you get, and it's available to any new or recurring members. Now, returning member means somebody that was a member before, they let their membership go. A lot of people do that, then they come back. We see this all the time. You're welcome to come in. You know the value of all this. 50 off. I don't care if it's a 1 month or a 1 year subscription. You can choose from either the morning subscriber video, the morning ETF subscriber, the combination of the two, and or my full research, which means twice daily updates, special written updates coming to you, things you don't see anywhere on for free anywhere else. And then the morning subscriber video. So any package. Where are the packages? Under iraepstein.com research. We've already set the computers to do this. They will automatically revert to the higher price come Monday. You want to take advantage of this now. Do so. There'll also be a cursor at any time you want to hit up here, and just click that. It'll take you to the website where you have to be. It's all explained, and away you go from there. Pretty interesting. And we don't do this that often. All right. So let's take a look at SPY. I want to finish up with this, and then I'm not going to do this for a while. We'll move on to something brand new for next week. We have 4 days next week. Remember, the markets are not open on Monday, so you will not see me with my normal Monday videos. They'll start again on Tuesday. You've got distribution, sideways action going here, and I've been pointing that out to you on the daily charts. The pattern is not a trend right now. You have a lower low and a higher high. An uptrend would be a pattern of higher lows, higher highs. You don't have that. You've come well off the low into a rally zone. The resistance is strong at 420.23. The support is there at 394.51. The resistance gets even better when you add the Bollinger Band. Now, the Bollinger Band is an algorithm designed to keep the market trading within it 95% of the time. It is like owning the casino. The people that start coming in and selling under this, they generally get burned. The market pops back over the band, and the same goes if they buy it. But you'll notice, you don't get many people. Just take a look at the chart. You don't have to believe me. A lot of people don't buy over that band. They come back and they wait for it. The pros understand the logic of it. But it's also a natural resistance point and a natural support. Now, when it gets very narrow, it will break out of that one way or the other. You're not very narrow. right now. You're in a normal width pattern of it, as I call it. So I'm still saying, okay, if it's going to correct, I'm not looking for a crash, but 394.51 could be a support zone. When we take a look with the slow stochastic, you're overbought. Slow stochastics are a momentum index that's made up of two lines, the red and the blue, called a K and a D. And if they're both going sideways over 80, it changes from being overbought to locked in with a pattern. See that? And look what the market did. It warns you. People don't believe that, and that's just what you want. You want to get the guys that don't understand momentum, because momentum leads price most of the time. And when the momentum is just staying strong and that guy's trying to say, I can't keep going, yeah, you need fodder. See, the market does keep going because he's going to buy his way out of that position. When you lose the momentum, you often get a correction back to that average, and that's what happens. Well, you're not there now. You've just gotten overbought recently, oversold, overbought, came down, overbought. So a correction is in the cards if it keeps going that way, possibly back to that 394.50. In KBE, we're overbought. The trend has been up, but I contend the first time you hit a Bollinger Band, what are you waiting for? Take your money off the table. If you're embedded, you don't take all your money off. You take something, not all of it. You're not embedded. I think the pros came out. And no, I'm not bearish this. Anytime you're over this average, I am not bearish on a weekly chart. I am looking for potentials to buy, and if they don't show up, you don't buy. You just don't go rushing in. And I would never tell my clients to buy a Bollinger Band or sell a Bollinger Band. Not going to happen. In XLI, you're starting to get the 18-day average and the 100 attacking, and you got over it. So there's a bullish crossover in this at this point for the industrial sector. What else? You're embedded. So until the red line closes under 79, the bulls have taken control of the market. Can they make it do anything? That's the question. I think the pros are buying, and their objective will be wherever the upper Bollinger Band comes in. If it closes under 79 on the weekly chart, they'll go away from that trade. In XLE, they turned bearish. The market has got a pattern of lower highs, lower lows coming in now, and you're looking for the lower Bollinger Band as potential. But let me give you the but and teach you something. Whenever you narrow in like that, here was normal. Look at the differences. What often happens is you don't hit the Bollinger Band top or bottom. You spin at the 18-day average, and you churn people up in the process. It is the spot to avoid. If you're going to be in it, the bearishness is right until you take out this week's high. Got it? This week's high is very important in the market. In FXE, you had an embedded reading that you lost. Let's take a look. Do you disagree? You had embedded and the market's moving to the upside. There is a way to buy the breaks in this market as that is occurring. I teach that in my enhanced Bollinger Band course, and I think you learn a lot from that. Now, when you lose the trade, here you are, last week, under 79 is the key. You weren't under 79. Now you're under 79. When you lose it, the odds are very strong that price and the 18-day average are going to come together, right? That's how I trade it. Now, I'm going to create a service. I'm working on it now that gives you trades like this to get to that number with a stop and everything else for you. So a way to trade opposite off of purely one thing, loss of momentum in the chart. In the gold market, what do you think's driving gold right now? Well, let me just walk you to this. Here you are the first time you're under. You get a 76 reading. I contend now that before this high is taken out, price in the 18-day average or the closest of the 100, the green, and that will come together. I'm looking for this to happen right now. Okay? It's a big tool. Momentum is a powerful tool if you know how to work with it. When you lost the embedded reading here, here's your momentum. Market ran into the resistance. Where would I tell you? You're my client. You're sitting there. You're on the phone with me because people do call me and they'll talk to me. And I go, where do you think? Okay, well, if you want to come down here to 2860s where I think. And the people that talk to me will pay me a fee for if they want that. They can hire me and I'll be a consultant to them. Boom, I'm looking for the 2860 level. What do you do now? Out you go. That's all it was worth. You're not trending. You have a higher high and lower low. The money's been made. Let's turn our attention elsewhere. Tesla, overbought as can be, not in a trend. I know you're going to tell me it is trending. Well, it is at the end of the day today, but it hadn't been. You're now having, and I'll show you why I think that is the case. Let's back off from here. What was last week's range? If we look at it, 189.55 low, 214 high. You made a lower low at 187.61 and 217.65. You have an outside week up. That gives you higher lows, higher highs. If you take out this week's low, this coming week or the week after, the odds are super strong. You're going to go back down and challenge wherever the 18-day or the 200 is, the closest of the two. Until that occurs, the target could be up here at 208. Now remember, this is a market that was just at the 102 level. It has almost doubled in value plus. That's a pretty interesting chart. Tesla's done well, and as Tesla's done well, the woman with the guts to buy it at any price has been Cathie Woods, and it's carried up to the upper Bollinger Band. So she's come off her lows. It's not a stellar move, but she gained the third back. She lost everything last year. She had to be amongst the worst, if not the worst performing hedge fund. That doesn't mean that her time in the sun won't come at some point again. This isn't it, unfortunately. This is sideways action. A bounce off of a bear into an upper Bollinger Band doesn't convince me this is it. In Apple, you're overbought. That bothers me. You've come up from the lower band, just like an arc, to the upper. I'd be very cautious. These markets have to prove that they can stay up there. They're in dangerous area. Meta, and I realize how bullish Meta got, but you've got to throw emotion away if you're going to be a chartist. You go back to your tools. What are the odds of a market staying over the upper Bollinger Band or the lower one? 5% of the time it happens. I count each consecutive close over it as taking away one of those percentage points. So here you are with the market that finished at 151.74 over the band. That's the first week over. Second week over. Coming in, and that was February 3rd, I now give the market a 3% chance of staying over that band. Now you pull back on February 10th, literally to the band, but still over it. Now I give it a 2% chance this week of staying over it, and boom, you're right back into it. Are you getting the logic? So what it's done is I'm not taking away your bullishness. I'm saying that the way I teach this, and I teach this in that enhanced Bollinger Band course, there's a better entry point, and I explain it just the way we're doing. Now the problem is, with the close at 78.81, I don't want to own it. My work is saying that unless it immediately, let me define immediately, this week coming up, gets both numbers to close over 80 again, the odds are strong. The price and the 18-day average are going to try to make a run at each other one more time. TLT, all right, this is front line, but it's not quite. This is the 20-year plus T-bond ETF. That is the area that is not where the Fed is going to move. The Fed's going to move in the 6-month, the 2-month, the 2-year at the max. And you look at the 6-month T-bill all the time and you say, it's almost like a surrogate for Fed funds rate. But as it goes, so goes the rest of the market with it. Mortgages went from 6.12 on Thursday. The latest number last week, they were 6.12. Now they're 6.32. So you look as the curve yield is starting to move across the board. But this is the neutral point. The market's not trending. You're at a neutral point. I don't want you to stay neutral. I want you to join me on the President's Sale. Move your cursor up here. It'll take you right there. IraEpstein.com research. It ends Monday. You won't be seeing this for a while. You have a good one. I'm Ira Epstein. I'll see you Tuesday.